Hi, my name's Nick Ballou. I'm a patent attorney. People often ask me, is it worth it to file a patent? Should I file for a patent? And I think this should be an economic decision. Um, are you going to make money off this patent? And if it's a product that you're only selling a few of, if it's a small market, the cost of filing for a patent may be more than you're going to receive back from the patent. So it may not be worth it to file a patent. So I have a few financial considerations I thought we could look at for, whether you should file a patent or not. We have is the total revenue greater than total cost? Is look at the return on investment, the internal rate of return. You can look at the market share, and you also look at the market demand over the life of the product. And I have a few spreadsheet examples of where I calculate these, rate of return and ROI for, in different settings. Before I get to the spreadsheets, I wanted to cover a couple concepts that I use. So the first one's alternative products. And my hobby is playing bass guitar. And I have some examples here of different pickup designs designed by Leo Fender, who invented the electric bass guitar. On the left-hand side, we have a jazz single coil pickup. Then the top right, we have a split precision bass pickup. And then in the bottom one, we have a humbucker pickup. So I'm saying for bass pickups, there's three different possible designs. So if you have a patent covering one of those designs, it's 1 in 3, or you're covering 33% of the market. The next concept is strength of patent. So back sticking with the bass pickup example, you have windings around the magnetic core of the pickup, and you can have typically between 7,000 to 10,000 windings. So the patent claim may say 9,500 to 8,000 windings. So if that's the case, I say the number of configurations covered by the patent versus the total number of possible configurations. So in our example, if it's you cover 9,500 to 8,000, that's 1,500, and then there's total of 10,000 minus 7,000, 3,000. So you're covering 50% of the possible embodiments out there. So for this example, I'm saying that our market share is the strength of the patent times the number of alternative products percentage. So for our pickup example, if the patent's 50% strong and it's covering 33% of the market, I'm saying that the market share is 17%. This is my first example. So this is, I'm calling this a steady demand product with a strong patent. So in the first column, we have the year. So typically you'll file a patent application, then it'll take about 3 years to get the patent, and then the patent's valid for 17 years after that. So the whole life cycle of the patent is about 20 years. So that's not why I have years 1 through 20 here. In the second column, I have attorney fees. In year 1, I have $10,000 that it would be for the attorney to prepare the patent application. Years 2 and 3, $3,000 if there's a couple RCEs, office action responses to do, or if you have to have an examiner interview, that's that money. And then in years 6, 10, and 14, there are maintenance fees. So the attorney may charge a little fee for paying for the maintenance fees. The third column is USPTO fees. So here, year 1, the patent office, they charge fees for filing a patent application. Years 2, there may be a request for a continued examination fee. There could be other fees. And then year 3, maybe there's another RCE and you have to pay an issue fee. So I have 4,000 there. And then years 6, 10, and 14, you can see that there's increasing maintenance fees. So those are the two costs, the attorney fees and USPTO fees. The next column is the strength of patent, which I previously talked about, how many, options, it covers. So I'm saying this is a strong patent that covers 50% of the options. I have alternative products, percentage to say how many alternative products it covers. So in this case, we're saying 33%. And then I'm saying the market share for this, is the strength of the patent times alternative products, which is 16.5%. Next column is the size of the market. So I'm saying that this is a steady demand product. It's $200,000 through the life of the product. And then, so that means our sales revenue for years 1 and 2, the patent doesn't exist, hasn't been issued yet, so it's 0. And then years 3 through 20, it's the market share times the size of the market, it's $33,000. The final column is the net cash flow, which is if you take the sales revenue and then you subtract the cost. So for year 1, there's 0 sales revenue and there's $12,000 in cost. So there's a negative $12,000 cash flow. Year 2, 5,000. Year 3, you have $33,000 of revenue, but there's 7,000 in cost, so it's 26%. And then it's mainly 33%, except for the years where you have maintenance fees, and it goes a little lower. So the right-hand column is an important column. It has your cash flow. So the total cost for, in this case, is the attorney fees and the USPTO fees over the life of the patent is $38,900. The total revenue, the sales revenue is $594,000. The return on investment ROI is 1,427%, and the internal rate of return is 101%. Now, this is my second example. The numbers are very similar to the previous example, but I'm saying this is with a weak patent. So in the previous example, we had the strength of the patent at 50%, and in this case, we have 5%. So that means that we're only covering, basically 1 in 20 products out there being sold. There could be a lot of design arounds of the patent. So we're saying that this is a weak patent at 5%. Because it's a weaker patent, our market share goes down a lot. So now we have 1.7% of the market share. I kept the size of the market the same at $200,000. The sales revenue now has gone down a lot to $3,300 a year. And then this changes the net cash flow. So years 1 and 2 is still negative because the patent hasn't been issued yet. We have negative cash flow. Year 3, even when it's issued, you're still negative. Year 4, 5, you don't have any costs, so there's a positive cash flow. When you have the maintenance fees, it's negative again. So that's what the cash flow looks like if you have a weaker patent. The total cost again is the same. It's $38,900. The total revenue is much less, $59,400. The return on investment goes down to 53%, and the internal rate of return goes to 8%. So this shows the importance of the strength of the patent. If the patent is covering a lot of the market out there, you're going to get a much higher rate of return. So this is why the strength of the patent, how good your claims are, matters from a financial perspective. This is another example. I'm saying this is a product that becomes obsolete like an electronic device. If you think about, like a technology like an iPhone, they come out with a new iPhone and then people want it for a few years and then they stop buying it. They're selling new iPhones and it goes obsolete. So if you look at our alternative products, if you remember my formula, I had the number of products covered by the patent divided by the alternative products. So you can look at this different ways, but basically the number of products out there that are competing just goes up, and then the products that you're covering that are out there goes to 0, and the denominator gets bigger. So basically you're not selling anything, and then basically your market share goes to 0%. So if you look at the market share, without the patent at 0%, it goes to 30%, and then from the high of 30%, I'm just saying it decreases 5% a year until it goes to 0. Which again, this is a technology that becomes obsolete. And the market share, so if we say for like smartphones, if you're saying that this technology keeps going up, so have the market share, the size of the market going up, and the sales revenue, again, the first 2 years you don't have anything. I'm multiplying the market share by the size of the market, and it's going down because the product starts off as being a hot product, and then it becomes obsolete. So then you don't have any sales revenue starting at year 9. And if you look at the cash flow, I'm saying that this may be a more of expensive patent to prepare. So I have 17,000, then I have 7,000, and here's the cash flow. And then after the sales stop, it goes to 0. And then interesting, there's no sales, but if you want to keep this patent alive, there's still these maintenance fees out there. So you have these negative cash flows for the maintenance fees, which is another, important point, that if you have a patent that's covering obsolete technology and you're not making any money off it, you can consider not paying these patent fees. And if you do that, these maintenance fees, then the patent will go abandoned. But if you're not making any money off it, that might be the wise financial decision to make. So if you look at the total cost on this, of the patent, 47,900. The total revenue is 1,203,000. The return on investment is 2,413%, and the internal rate of return is 338%. This is another example. I say it's a product with increasing demand over the lifetime. So this could be a medical device or a pharmaceutical. If you look at like Ozempic or Lipitor or some of these pharmaceuticals, doctors start prescribing them, and then just as the life of the product, it's prescribed more and it just keeps growing. So I'm saying that the size of the market here is increasing 10% a year over the lifetime of the product. So if we go through the columns, like if we say it's a medical product, maybe it's a more expensive patent to file, so I have $25,000 here. I'm saying the strength of the patent, maybe it's a really strong medical patent. There's not much alternatives. So both of these numbers are real high. The market share is 81%, and the size of the market keeps increasing. So your sales revenues here, the first couple of years, again, you have negative because the patent hasn't issued yet. And then the net cash flow just keeps increasing. So your total cost is 59,900. Your revenue is 36,935,000. The rate of return on investment is 61,000, and the internal rate of return is 490%. So obviously, in this case, if you have large cash flows, if you're making a lot of money, the cost of the patent, it becomes really small compared to the revenue you're making off it. So in summary, I think if you're deciding whether you want to file a patent or not, I think you have to look at the economics of it. If it's something, if you're not going to get a lot of sales revenue off of it or licensing revenue, or if you're not going to sell the patent, if you're not getting some kind of income stream off from the patent, then you're just going to have these costs. And from an economic standpoint, it probably doesn't make sense to file a patent if you're not going to recoup your costs. So you can look at the total revenue and the total cost. You can look at the ROI. You can look at the internal rate of return. You can look at the market share. You can look at the market demand over life, and just consider how the product demand and what your patent's going to be worth over the life of the patent. I have another video posted. It's about reducing patent costs, that looks into ways of reducing the attorney fees and some of the USPTO fees. So if you reduce your patent costs, then it can change this analysis and make it look more favorable to file a patent. And then I have some ideas for future possible videos. Review the steps in the patent process, evaluating the strength of the patent, which I had said in this video. I pointed out, if you have a strong patent that covers 50% of the products out there versus 5%, it can have a really big impact on the economic analysis. So I think that that's important topic to cover, what impacts the strength of a patent and how you can get a stronger patent. And then also, I'm taking suggestions for other videos. If there's other topics that anyone would like me to make a video on, please let me know. So thank you very much for watching my video.